Hi, everybody, and welcome to Harvested Financials podcast, your journey to personal finance. Today, we have a very exciting guest with us here. We are joined by John Manley. And John has been an options trader and investor for years. He's worked across the education space, the institutional side of things, and has really fantastic insight into how to become a better options trader. So I'm really excited to talk to John and learn a little bit more about his history, but then also talk about some of the challenges that early traders come to and how to think about trading and how to develop a kind of systematic approach to trading profitability. So welcome, John, and thank you so much for joining us.
Hey, Mark, thanks very much for having me. I'm excited to be here.
Great, great. Well, why don't you give everyone a little bit of background about how you came to options originally and what brought you to this fascinating world of derivatives?
Yeah, I'll try to keep it brief. It's kind of a long story, but I got hired as an execution trader back in 1999, right at the height of the dot-com bubble, and it was just pure craziness at that time. And as an execution trader, I wanted to be licensed to trade options also. So to do that, I had to take certain coursework to get licensed to do that. And as I started studying options, I just became fascinated with it because I, like everybody else, thought, if you wanted to make money in the stock market, you had to buy low and sell high. And all of a sudden, options came along, and there was all these wonderful strategies that you could be implemented where you didn't have to have rising prices to make money. There were other profit zones in time value and in implied volatility and price changes and that sort of thing. So that really, really fascinated me. And I took a deep dive into that, took a whole series of coursework related to derivatives, and in 2001 was granted the derivatives market specialist designation. I'm from Canada, by the way, so I worked in the brokerage business in Toronto, Canada. So when I got that designation, I became supervisor of options and equity trading at TD Bank here in Toronto, and did that for about 5 years. And part of my function was to analyze risk in large option trades that were coming through from customers. So I had to really, think on my feet very, very quickly and determine what the net exposure to the client was, to our firm, everything else was in these option strategies. And I just took a really deep dive into it and had a lot of success with it. And then in 2005, I broke away and started my own money management firm. And that was for a group of high net worth clients. And it was a market neutral approach that I've been trading ever since 2005, and did that right up until I would say, the middle of 2019. Had a lot of success with it. Over that time, as I look back at my performance record, we kind of did an average 32.5% annual return over the course of about 15 years. And, that was through the crash in 2008. It was through the flash crash in 2010 and the Euro crisis in 2011. And I've refined my approach to market neutral. And that's all I trade now. I have two strategies to approach the markets. One's for low vol and one's for high vol. And that's it.
Okay, interesting. Well, tell us a little bit more about market neutral and what does market neutral mean to you? I mean, that sounds like one of those concepts that is different about options, right? You said that stocks go up or they go down, but neutral isn't in our vocabulary as stock investors. So what does market neutral mean to you?
Exactly. So market neutral means just that. We're not trying to pick a price direction in the markets. And we have profitability to a certain range to the upside, flat, and a certain range to the downside. And really what we're trying to do, Mark, is take the price equation out of it and profit on the other two pillars, which are time value and changes in implied volatility. So my determination, if I could neutralize the time, or I should say the price exposure, that I could profit on those two other pillars. So that's essentially what it's all about.
Okay, very interesting. And so is this one trade that happens, or is this a series of trades? How do you think about entering and exiting different options positions over time?
Yeah, great question, Mark. So it's essentially like I say, it's divided up depending on volatility readings. So I have a low vol strategy. And if we use the VIX as a reference, I mean, back in 2018, 2019, the low for the VIX was down around 10 or so. And the VIX used to vacillate between 10 and 22. Now we're in a new regime, where the low on the VIX is 20. And, the high is, we hit 40 just recently. So we're kind of in this new regime right now. And so I would mark currently, unless it changes, a 20 VIX as a low vol. Mm-hmm. So essentially what I'll do is I'll implement my low vol strategy when the VIX gets right down to the bottom of its range. And again, I'm just using that as a reference. My trade, tenor is usually about 4 or 5 weeks with the positions that I put on. So the VIX is not a bad proxy, but when I model the trades out, I'm obviously looking at the individual leg implied volatilities and determining, what strikes to put on based on those realities.
Okay. I'm hearing a lot of systems here, and one trader investor that I've heard you talk about before is Mark Douglas. And I'm really interested in hearing you describe kind of how his work has been influential, because I think he does emphasize this systematic approach. And it sounds like you very much categorize your approach to the markets along distinct lines, and that's how you implement your strategy.
Exactly. And Mark wrote a great book many years ago called Trading in the Zone. And for any budding or even novice or experienced trader, if you haven't read it, I would certainly recommend reading the book. Mark was a market maker from Chicago. We just lost him recently. He just passed away recently, unfortunately. But he wrote a couple of great books. But it completely changed the way I approach the markets because I was like everybody else. I was looking for insights, research, analysis, opinion, maybe having a bias on whether something's going to go up or something's going to go down. And what Mark helped me really change was getting rid of all the emotional aspects of trading and turning it into a pure numbers game. And just to give you just a really high level overview and example. So if you're a trader, and it doesn't really matter what your approach to the markets is, it could be spreads, it could be value, it could be momentum, it could be directional, whatever your approach is. Number one, you got to have a system. You have to have a rules-based system for entry, for holding, and for exit. And surprisingly enough, Mark, a lot of people don't. They may think they do, but they may be loose around that system, where they may change their rules as the market unfolds. So you need to have a system. And once you have a system in place, you need to trade it. And if it's something that you haven't really tested in the past, and what Mark recommends is doing a sample size of trades. So let's just say that you have your system down. Step number 2 is to do a sample size of trades, whether that's paper or live, big or small. And let's just say your sample size is 20 trades. Now, depending on your trading style, that could take a week, it could take a month, it could take 6 months. But after you've done your sample size of trades, stop trading, score yourself, look back at what you just did. What over your 20 trades was your percentage win? What was your average win size? And what was your percentage loss? And what was your average loss size? So that gets plugged into what's called an expectation formula. So simply just 2 sides of the formula, as we just talked about. In the first brackets is your percentage win times your average win. You're going to get a number out of that, minus your percentage loss times your average loss. And the sum of that equation, if there's a positive number there, your system has an edge. If you're able to continually map out those types of results, your account will rise over time. It has to. So if it has a negative number, then you should stop trading your system right away, because it means that over time your system's going to lose money. But it applies to all approaches of the markets. I have a particular approach that's comfortable for me. I know, Mark, you probably have some that are comfortable for you. And every trader is different. I sort of liken trading to clothes. Everybody has their own style and what they feel comfortable with and what they need. I have mine, you have yours. But no matter what, if you apply that thinking to the markets, that you're going to develop a system, you're going to trade a sample size of it, and then you're going to score yourself. And I think the refinement comes from, Mark, is having the output of that formula get bigger. So if the output of that formula is $200 and you do 20 trades, that simply means encompassing all your trades, including your winning and losing trades, you made $200 per trade. Let me just give you a quick example. So if you have a trading system that wins 50% of the time and loses 50% of the time, but your average win is 1.2 times the size of your average loss, your account has to go up over time. So the great thing about options, and you know this already, Mark, is that, with the idea of spreads, and let's just say, out of the money credit spreads, I mean, the probability of profit is highly in your favor. So if we put on a out of the money credit spread, I'm just assuming that your listeners kind of know what that means. But there's four outcomes, with that. The market can go higher, it can stay flat, it can go down to a certain degree, or it can really fall. So with an out of the money credit spread, a bull put spread, as they may call it, we have a 75% probability of win because we're going to win on out of four of those outcomes. Now, the reason we have such a high percentage probability of win is because it's way out of the money. Now, the other side of that coin is that the risk reward measure on that trade is terrible. You might pick up a $1 credit for $9 in risk. So that's the downside of that. But having said that, if you can manage your risk in that trade, over the course of the year, let's say you put on one a month and you win on 11 of those months, and one of those months you lose. Now, the trouble with that trade is that 1 month that you lose could wipe out all your other trades that you won on for the rest, the previous year. But if you manage your risk in that and you say, hey, listen, you know what? I collected $1 credit on that. I'm willing to lose. I can see by my system that if I lose double my credit over the course of time, I should still be okay because I know the probability of me winning on that trade is okay. So it's thinking about it in those terms. People used to ask me when I was running the fund, they said, John, what do you do? And I said, number one, I'm a risk manager. And number two, I trade liquidity. Because, they'll ask me, say, hey, John, what stock do you like? Or what sector do you like? Or do you like this? Or do you like, I said, I have no opinion whatsoever. And I have no idea what the market's going to do next. Neither does anybody. It's pure conjecture. It's a coin toss.
Let's jump into liquidity there actually for a second, because I think that's really interesting. As a former market maker, I think a lot about liquidity, and I think that's a really interesting way to frame how you approach the market.
Yeah.
One definition I've heard of liquidity that I thought is great is the ability to get out of a position when you need to.
Yeah.
How do you think about liquidity, and what is that? Maybe you could elaborate a little bit more on how you trade liquidity necessarily.
And I agree. Yeah, it is. It's having a ready market there behind you. It's not only getting out when you want to, but hopefully getting out at a decent price.
Mm-hmm.
Because I trade SPX options, and as you know, Mark, that when stuff really hits the fan, those spreads really widen out, liquidity falls off the cliff,
Mm-hmm.
and there's a mid price, of course, and normally you can get filled, maybe a nickel off the mid, but in times of stress, you might have to go out 10, 15 cents, and that's a cost to you as a trader. And then with options on individual equities, it's like the Hotel California. They'll let you in, but when you want to get out, they'll just laugh at you, because the spread will be 50 cents wide and you're going, maybe at 10 cents off the mid, and they're just laughing at you. It's like, yeah, we're not going to fill you there. You come all the way down,
100%.
To our bid and we'll fill you there.
It's so true. And I think, in the US equities, you maybe get liquidity in the top couple single names, but it falls off a cliff right after that. It's only really the ETFs that you can get out at a fair price.
Mark, maybe you can elaborate on this, but I heard a stat that something like 90% of all the equity options volume is traded in, I think, the top 10 or 12 ETFs and stocks on a given day.
I believe it. And that trend has only been increasing. I think I heard that number was closer to, that standard 80-20 rule only a couple of years ago, but I think that concentration has only tilted up.
Yeah. So I think it's important and especially new option traders, to understand the markets that they're trading in also, and how important liquidity is in, because you may, buy a call option on something and it goes your way and you're making some money with it. But maybe you got 50, 60 cents profit in it. Then you go to sell it and you're going to take a 50-cent hit on the spread. And you just lost, most of your profit because of that. So it's like, well, for me, it's like, why even play there? Why not play in a more liquid market where you're not going to have that problem?
Absolutely. And, we've seen instances where we'll be closing spreads and all of a sudden something that's deep in the money, you start going across multiple different strikes, like with a butterfly type trade or whatnot, you're crossing that 50 cents 3, 4, times, and that gets really expensive very quickly.
Yeah, he can eat up a lot of profit or exasperate losses, as you say.
Mhm.
Yeah, but great question.
No, that's fantastic. And I think another interesting angle of systems is the ability to manage expectations. And you touched on that a little bit, that like the emotions of a trader, that they might, feel this way in this environment or when they see a position going against them. It seems to me that a lot about creating a system is having a way to recognize what might happen and what your possible scenarios are.
Exactly. And when I had opportunities to teach and I used to talk to new traders and such, and I said, listen, most traders will live and die by their last trade. So if your last trade was a winning trade, it's going to affect you psychologically. You're going to feel good. You're going to feel a little more confident. If your last trade was a losing trade, it's going to pull you back a little bit, and you're going to feel a little, hey, you know what? Did I do something wrong? Did I make a mistake? But my definition of a good trader is someone that follows their rules to the T. So you may be a trader that's had 4 losses in a row, but if you've followed your rules and your system to a T, you're a great trader. You may be a trader that's had 5 wins in a row, but if you were rolling the dice and gambling, you're a terrible trader. You got lucky. That was it. So I remember when I first started managing money and such, I had, other people's capital, and that, made me a little nervous. But as time went on, I became more detached from it. It was just, John, follow your systems, follow your rules. Not every trade's going to work out, but over time, it should work out. And because you've tested it and you understand that if you manage your risk, you're going to be okay. So in that example I gave you earlier, Mark, where I say do a sample size of 20 trades, let's just say that you developed a system and your max risk on that system was $500 per trade. And you said, you know what, I'm going to follow my rules. I'm going to do a sample size of 20 trades. And you do that. Your first 5 trades went bang, 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 max loss. Well, that would mess up most people.
Yeah, that's
Most people
hard.
would say, I'm doing something wrong here. But no, you've proven your system. It's okay. It's just that market conditions were such that when you put your first, 5 trades on, you went max loss. But you got 15 more trades ahead of you. And I've done this. I've run samples like this where it's done that. It's the first 5 trades were a loss. Then all of a sudden you have a triple, and then you have a single, then you have a double, then you have a home run, and then you have some more strikeouts, and then you score yourself at the end of that, and you did just fine. Your count started here, and now it's much higher, although you had 5 losing trades at the beginning of it. So if traders can get over that psychological hump and take the emotion out. If you feel good about a winning trade and bad about a losing trade, you still have some work to do. You're sort of in that amateur mindset. You should feel indifferent to it. I mean, if you compare it to poker, you look at the top poker players and they're dealing hands, and they're not pounding the table when they have to fold their cards. They're just keep that steady Eddie trading, follow your system. And I think traders will see that they'll make money over time if they stay to the rules of their system.
Yeah, randomness can be so confounding, and
Yeah.
as a human, we're not meant to process what random numbers look like, and the odds of 3 losses and 5 losses in a row.
Yeah.
But it's having that system allows you to really see independently detached what the results are.
Exactly. But important concepts for trader to think about, I think.
Absolutely.
Yeah.
So in terms of developing a system, I heard you reference the sort of high vol environment system and the low vol environment system. And markets change over time, right? The system that works today might not be the system that works tomorrow. How do you think about when it might be time to change that system, and sort of make that decision without, within the system, but also independent of the system?
Yeah, no, that's a great question. And, over my 15, 20 years trading options, I've traded every option strategy under the sun. I think I've made up a few of my own and have sort of distilled my approach. And again, this is just me, to my low vol and high vol system. And what I trade, Mark, is called adaptive market neutral. So I start off with a core position with the idea that I can evolve it to the upside or the downside, no matter what the market wants to do. And I'll go back to kind of late summer 2011. And the market had fallen off quite a bit because of the debt downgrade in the United States for the first time and the euro crisis that was happening. But what was happening at that time is that there was a big disparity in the implied volatilities. And I was trading SPY options at that time So I started looking at some calendar spreads, and I said, you know what, these front month contracts are really, really expensive. So if I can, sell those front month and buy the back month, and I was more monthlies at that time, but there was about, I guess I'll deal in basis points, about 1,000 basis points of backwardation between the front end and the back end. And what I did at that time, Mark, was put on a series of calendar spreads up and down the price spectrum on the SBY. I had 3 above, 3 below. And I told myself, I said, listen, if I can manage the delta in this, I know that front end backwardation arbitrage is really going to come down. And as it turned out, it did. It was a beautiful trade. And I traded that for the rest of 2011. The fund was up about 46% that year versus a flat SBY, SPX on that year. But you're right, as we went into 2012, that arbitrage went away. And the trade didn't work that well anymore. But going into the Volmageddon that we had in 2018, first quarter, after that, once again, I started looking at calendar spreads again and was looking for that backwardation. And what I kind of discovered, and the cool thing about the SPX, as you know, Mark, is you get the Monday, Wednesday, Friday expirations. And I was doing different combinations of expirations, but what I found, maybe I shouldn't be saying this, but it's coming a bit, but there was a natural backwardation between Friday and Monday options. So I started building calendar spreads, selling the Fridays and buying the Mondays. And I was looking, I said, okay, well, that looks great. What's the Vega ratio look like? Because, and this is a little more advanced for your advanced listeners such, but I wanted to look at the Vega between the front end and the back end and look at the ratio between those. I wanted it to be very tight because I didn't want to have a lot of Vega exposure to that trade, and started trading those double calendars, a put calendar to the downside, a call calendar to the upside. And it worked fabulously well all through 2018. Paid off really, really well. The arbitrage, or when I say arbitrage, the backwardation between the front and the back end was about 150 basis points. That's a far cry from the 1,000 basis points it was back in 2011, but that's part and parcel to high frequency market making. As you know, Mark, everything's become arbitraged out to a certain degree, but it still works very, very well. And since that time, other traders have picked up on that trade. Now the backwardation is about 50 or 75 basis points, but it still works very, very well. So that's kind of my core low vol strategy is really double calendars. And with them, if the market wants to, move to the upside or the downside, I'll start to adjust those into diagonals, either one way or the other. Mm-hmm. And that kind of, I can take all the risk out to the downside. I can take all the risk out to the upside. And they're fairly short-term plays, generally about 3 weeks or so. But the ROI in those things target is 30 to 60%. So, because they're cheap to put on, as you know.
Mm-hmm. Well, what's really interesting, you said it there in terms of like managing into a diagonal and managing with the delta before. I think that's a really interesting concept with options, because you're talking about how, there is this backwardation, whether it exists on, 1,000 basis points or 150 or even 50 basis points. That's sort of independent of the specific strikes that you might end up trading, and where the market goes is going to have a certain path dependency to that trade. So the fact that you have a calendar spread on also needs to have this delta aspect managed to it, because of where the market might go necessarily, even if this other ratio is might persist. So maybe could you explain a little bit more about that and what you mean by managing the delta of a trade?
Yeah, and the nice thing about those trades too is the gamma is very, very small with those things. Delta is very, very small. So by putting put calendar onto the downside, a call calendar onto the upside, it starts off very, very delta neutral, and then unfolds that way too. The break evens widen out pretty quickly in those things. So delta and gamma is not really a big deal with them. I'd like to see it move down to the short strike on the put side or the call strike on the upside. Probably the biggest risk in that trade, Mark, is I always seem to make out better when the market moves down, because we got a bit of a Vega effect to the upside. And as you know, when the market rallies, Applied's going to come out a little bit. I still have a somewhat positive net Vega there. The cool thing about calendar spreads, though, is that those Vegas, or I should say the implied volatilities, move somewhat independently between the front end and the back end. Not much with these because they're Friday and Monday expiries. So I'm trying to neutralize the negative effect. I realize, and that's why I call them low vol. You put these things on when the VIX was around 10 or 11. It's extremely difficult to lose money in those trades. just because the VIX has nowhere to go. And again, I'm using the VIX as a reference. The risk in those trades is you put them on when the VIX is at 25 and it falls to 15. Well, that thing's going to sit in the mud. It's not going to do much. So that's why I sort of have a mid-vol variation with that, where I might start off with a double diagonal where the volatility affects not as much as it is with the calendars.
Okay. Interesting. One of the main topics right now, of course, in the volatility space has been the elevated volatility. You talk about the VIX maybe having a low of 20. As the US election gets resolved, I think we saw very high volatility through November, December, January. How do we play this environment going forward? If we are going to see a deflating vol compression coming back in, potentially adjusting and shifting from a higher vol environment to a low environment, what signals might we look for if we were to shift regimes here?
Yeah, so I'm currently trading my high vol strategy, which is, if I shared with you before, is the deep hedge, deep out of the money, broken wing butterfly trades. Really trying to take advantage of some of the volatility skew and the idea that those are really just two verticals smashed together, and that one's going to waste away faster than the other one. And I tried to put those on at a credit. And so there's really no risk to the upside. And I have a certain percentage return I'm looking for in those things. And again, that's a 5 or 6 week play. And I'm looking to garner maybe 7 to 10% return on those plays, and just rinse and repeat that every 5 or 6 weeks. And I could put those on in fair size. And again, and we've had discussions already on how to potentially hedge those things to the downside, because there is some risk to the downside, but there is a very easy vertical hedge that can be put on to pull that risk out. And also some discussions around the idea that, if the market did face some sort of terrible event, there may be an opportunity to hedge some of the volatility with some fixed call options. But I mean, that's a whole different discussion. Probably don't have time to get into it today. But with the idea of the changing vol regime, kind of falling off into the end of the year, which is a seasonality type of thing, the butterflies, for me anyway, seem to work really, really well.
Mm-hmm. Yeah, butterflies are a great vol capture trade. We really like them as a defined risk type tool that exactly what you're entering into at a debit, and exactly kind of where your break evens are. It's a really nice risk management tool, the butterfly trade.
Exactly. So that's how I'm engaging the markets, and it's worked really, really well and continues to do so. So fingers crossed to the future that liquidity holds up.
Yep, you and me both. I think we all. More liquid, deeper markets are great for all participants.
Exactly.
And we've seen a lot more participants come into the options markets over the last 6 to 8 months. I think at the OCC level, the Options Clearing Corporation, they're seeing their numbers go up overall, but the percent of retail that's contributing to that is a bigger share than it's been in the past. I'm hearing retail numbers over 40, touching 50% of volume on any given day. So with all these new retail traders coming into the market, so many people trying to learn about options, what would be the advice that you'd have to them on their first journey to learning about options?
Yeah, I would say number one, education. I'm a little concerned that folks are going on social media or some sort of threads, platforms, Reddit, and that sort of thing, and getting kind of hyped up about buying out of the money call options and the high flying tech stocks. And that can be a very, very dangerous game to play. So I think for new traders that are interested in options, is a fascinating space, as you know, and something that I continue to be very fascinated in. Education is the key. Understanding, what you're buying and, the volatility that's priced into those things and what the underlying needs to do so you can profit from that, and how to manage and reduce risk. And just as a quick anecdote, when the markets really started to wipe out in 2001, the dot-com crash, I was a supervisor on the equity and options trading desk. And, it's a bit of an analog to what's happening now, because in 99, it was the same thing. Everybody was getting into options. And Mark, I saw people take $15,000 accounts and turn them into 7 figures. But in 2001, I saw them give that all back. Part of my job was I'd get, it was more manual in those days. I get a list of folks that I have to call, for margin calls. I say, listen, you need to deposit $500,000 to your account today to get you back on side. I saw accounts that, went from a few $100,000 to they owe the firm $100,000. I mean, risk management systems are in place now that can't really happen anymore. But back in the day, it was a lot more manual. And so I hate to see investors go through that where they do have the potential with education, I think, to do really, really well consistently over a long term. But just to read some threads on social media and go out with a Robinhood account and throw a couple $1,000s into some out of the money call options, that's more akin to just pure gambling. But I think with education, even with a couple $1,000, they can do okay.
No, I totally agree. And I often like to, analogize that the game of investing is a lot like playing good tennis, that if you can just keep getting the ball back over to the other side,
Yeah.
you're going to do pretty okay. And if you want to
Yeah.
keep staying in the game, that's the number one survival technique, is just live to trade another day.
Exactly. No, I agree.
Well, that's fantastic. I think that's a great piece of advice to leave all of our listeners with here. That it's staying in the game and risk management, and education is really the foundation of building a good trading strategy.
I agree.
Yeah, well, John, thank you so much for joining us today. We really appreciate all the insights. And I think I'll be asking you back to talk about some of these more interesting exotic things like the VIX hedges that you suggested there. So hopefully we can have you back on again soon.
That'd be great, Mark. It was a great pleasure. Thanks very much for inviting me. Thoroughly enjoyed it. I just hope that anything I share with you kind of helps everybody a little bit anyways.
Great. Well, thanks again, John.
All right. Thanks, Mark. Have a great day.